is an asset and it has value. And talking to the right financial stream, you can now.
We purchased it at 410k. Its current value is 900, around 900k.
We make sure we do not offer shoddy accommodation. That's one of the greatest things that needs to be emphasised. If you're going to get into this game, do not be cheap and cheerful, poor quality. Let your standards reflect what you're offering and what you're about.
Brilliant. Ade, I'm not in the room alone. Hi, welcome.
Hello, good evening, everyone.
Good evening to you all. So, thank you for joining us. I am Dee and Nelston, and this is my co-founder and colleague, Ade Stone, and together we are Nelston Property Consultants. So, thank you for joining us. Before we kind of go into anything, I'll just do a little bit of housekeeping right at the beginning. And that is to say that this webinar will be about 2 hours long, but it's going to be broken up with a first part and then a Q&A. Short little break, comfort break for the loo, water, anything like that. And then we're going to go into the second part and have a final Q&A at the end. I would suggest you put your phones on silent so there's minimal distraction if you can. If you've got any kids or any grandparents or anybody that always wants your attention, put them out in the garden just for a while. You can let them back in when we finish. How does that sound? Okay. On top of that, we will be having our Q&A, like I mentioned, but what we'll ask you to do is to post those questions in the chat box. We have our admin team at the back, in the background, and they will be picking your questions up and hopefully firing them at us for the Q&A. All right, brilliant. One other thing I was going to say, feel free to use the chat box. If we don't get to all of your questions, please forgive us because we are against time. We do run a Q&A once a month, the first Wednesday every month. So feel free to come and join us for that and have your question answered there if we don't get to it tonight. So brilliant. So I am Dee and Nelston. And I'm a co-founder, as I said, of MPC. MPC was set up to help people create wealth through property and also to help people with any property issues. So it's to guide people, it's to mentor people into into growing their portfolio and also any issues that they might have with their property. There's no one to really go to ask these things and anything to do with finance and financing in property. So we are set up to do just that and to serve our community on that. Okay. My background is originally in banking. I then went on to get into business. I had a childcare business. And then after that, I also went into property. I actually started in property in the 1980s and I built up a portfolio in both residential and commercial property. Okay, so here I am on the screen. If you like, please feel free to scan that QR code and then you can get further information on me and follow me. I'm going to hand you over to Ade. Ade, do you want to come into the room?
Thank you very much, Deanne. Good to have everybody on. I'm glad to see those who could make it are with us now, ready to learn lots of good quality information and hopefully thereby make qualified decisions in their journey forward in property. Deanne has explained the agenda for this evening. So I just want to tell you a bit about who I am before we then quickly move on. My name is Ade Stone. I bought my first property in the 80s. I've been a youth worker, a teacher, maths teacher, so figures, as you can imagine, are my thing. Bought my first property in 87 with my sister, and every business I've been doing since then, I've put my profits really into property. I went into it full time in 1991 and have been doing property investments in the form of commercial, residential, buy-to-let. I think you name the strategy, I've either done it or I've got a property in it. So a lot of knowledge, a lot of information I'd like to share. So join us on this journey and let's impart it on you. So Deanne, back over to you.
Thank you. How impressive. So, gosh, Ade, you started in 1987. I started age 18, also in the 80s. I won't tell you guys what year. I'll let you work it out. But anyway, we've been in it for a long time. So it's just to show you that there's a wealth of experience within those years. Okay, guys, have you got a notepad as well for anything that you want to take down? Any notes or anything? Please do grab that now, just in case you need that. All right, excellent. So, shall we start off with our agenda? So, our agenda tonight it's all things finance, and we've got three, which we feel are the three main topics that people kind of use in terms of finance when buying a property. And that is number one, mortgages, number two, bridging, and then number three, an area which I like and have been more recently exposed to, and that's creative and alternative financing options, i.e. joint ventures and private finance, or private investors, actually, private investors, that should say. We're then going to go on to factors to consider before doing a recap, and then a Q&A session, which will be headed up by Ade. At that stage, we'll take a short little comfort break, and then we'll come back into the room and do a deal analysis. So I'm going to bring a deal up on the screen, and we're going to go through how we would analyze that deal. All right. And then we're going to go into another Q&A session for that deal analysis. And then that will be it for the night. Okay. So shall we kick off? Brilliant. So fund, that is such a key word in the property world. Anybody who wants to buy a property, anybody who wants to build a portfolio, anyone who wants to create wealth through property, the first thing that they will ask themselves is, how will I fund this? Okay, this is the key word. So let's break down what it means to fund. F is your financials. Assess your financial situation and your affordability. So what do I mean by that? You will need to know, what have I got in savings? You know, what are my earnings? What mortgage might I afford to be able to get, especially if it's a residential mortgage? Okay, we'll give you more details about other mortgages and how you assess those a bit later on. But, you know, you might look at your income, you might look at your tax returns if you're a self-employed person, or company accounts. You know, you might need to provide things like that, but you've got to assess your financial situation. You know, what have you got in savings? Do you have any equity in another property? Or do you have help from perhaps mum, dad, someone else? So assess your financial situation, and included in that is your credit score. Your credit report and your credit score is very important, because that will have an impact as well as to what product you might be able to get and what rates. Okay, so assess your financial situation, look at your affordability, and then decide. Okay, so you understand. After that, we're going on to you. U is for understand the types of finance available to you and what is required of you. So take, for instance, you've now gone to a broker, or you've gone to your bank or building society. 9 times out of 10, you'll probably go to a broker or mortgage advisors, you might know them as. And what you will want to do is then understand what's available to you. So, you know, is it just a buy-to-let loan? Is it a commercial loan? Is it, you know, a residential type of mortgage? Is it bridging finance that might be available to you? And if so, at what rate? You know, given your personal financial circumstance and what you're doing, what's available to you and at what rate? Okay, so understand what's out there. Also, it could be that you might be looking at private investors. So, you know, what is available to you to do this particular deal or to do this purchase? Okay. And also what's required of you. So the difference between perhaps going for a bridging loan where you might need to provide bank statements, you know, self-assessment, tax returns, and a credit score. If you're going to a private investor, they might not be interested in all of that, but you might need to onboard them as either a sophisticated investor or a high net worth investor. And that is qualifying them to be, you know, suitable to invest in your journey. Okay. It's deeper than that. And I'm just sharing, just the surface of that, but it's understanding what type of finance you're going to use and what is required of you to get that finance. Once you've done that, you're going to go on to N, navigate. So you know your financial position and your affordability. You understand the product that you're going to get or use in order to fund the journey or the purchase. And now you're going to navigate the market in order to find the right project according to your affordability. So whatever property is that you're now in a position to buy, you're going to go out and try and find that property. And once you've done all of that, you're going to move on to D. Now, this is the most important part. This is the part where you must not fall down. We do not fall down there. D, we have to deliver. Okay. It's no point doing all of that work and then not bringing it all together and buying that property. All right. So deliver, bring everything together and deliver on the deal. Excellent. Thank you. On to our next slide. So that was the macro look. We are now going to go into the micro look. We're going to go into the financial war chest. So it says daily news, it's war. So, okay, the reason why I'm saying the war chest is because when you go into that war chest, you want to look at, okay, what's in there? What tools will I need to do this battle? Okay. And you always start with a W, and that is where do I start? Where's my cheapest finance at? Which do I go for? So generally, your cheapest finance will be you remortgage it, unless you're going to go to the bank of mum and dad or someone else within the family. It's usually going to be you getting a remortgage or doing a remortgage on your home, because the interest rate that you will get will typically be lower than if you were going to go for something else. So it might be that you remortgage to do your purchase. Then if that's not going to work for whatever reason, what's next? Is it a case of you're going to go for another type of finance to fund that, a buy-to-let mortgage, which will be slightly more expensive? The interest rate might be slightly higher. The terms might be a little bit less rigid, so, or more rigid rather. So, is that the next step? And if that's not going to work, okay, do you need to go for a bridging loan? Does it mean that a bridging loan will be the thing that is going to get you that property? Okay, now it might be a quicker turnaround to get a bridge, but it's a bit more expensive. But a lot of people go in using a bridge to buy the property and then later on refinancing onto a long-term product or selling the property. Or could it be that you go for something more expensive and you go in all guns blazing now, and that's for with a private investor where they might charge you 10 or 12% over a 12-month period. It's less rigid in terms of all the hoops that you need to jump through to get it, but it's going to be a little bit more expensive, usually is anyway. But that's where we start. We start with a W. Has anyone seen the film? Oh my gosh, it's gone from my mind. Scarface. Thank you, Ade. So when Al Pacino is the last man standing he wants to be the last man standing. He's not going down. No matter what's coming at him. And it's all guns blazing. And that's how I see the private investor in this war chest. It's the big gun at the top, where you think, okay, I'm going to go for that one because I want to wipe the floor with everyone. I want that property. I'm going to go in as a cash buyer. I'm going to turn it around in 5 to 7 days, however quick they can do it. And you've got that property. No one else has got a chance. That's your big gun. That's your machine gun. Okay, let's move on to A. A is for approach. So you know what you're going for. You're going to approach and apply. So are you going to apply using a broker, or are you going to go to your bank or building society, or is it the bank of mum and dad, whoever it is, or private investor? When you think you know what it is that you're going to go for, you approach and you apply. Now, I always say, just as you would get 2 or 3 quotes with a builder who's going to come and do works on your house, I always say get 2 or 3 quotes from a broker. Now, the reason I say that is because a broker may have access to a different panel of lenders to another one. And if you go to your bank or building society, they're only going to have access to their own products. So I always say, go to a couple, and compare what you are being offered. Okay, so that's the R. Review at your options. Review what's been offered to you. What are the interest rates? What are the fees? What are the arrangement fees? What are the broker fees? Are there any penalties if you leave early or exit that product early? Review your options. Don't always just go for the cheapest interest rate. And the reason why I say that is because sometimes lenders lure you in with a cheaper interest rate, but they've got higher fees. And that means overall, you could end up paying more once you've paid all those fees than you would do if you'd gone for something which had a slightly higher interest rate. The devil's always in the detail. So always review your options. And then C, choose. Once you've reviewed, choose your finance project. Okay, so we've done the war. We've now gone on to the C, and we are walking. Okay, we're walking, but we want to run. Okay, H is for hire. Have your team in place and ready. Your solicitors, your builders, your estate agents, your planning consultants, if you're putting in any planning permissions, anyone that you need, have them there and ready to go. Okay, the game's about to get serious. E, engage and liaise with all parties. Okay, don't just put your builders in there and then think, okay, they know what they're doing, leave them to get on with it. No, and your solicitors as well, engage with them throughout the journey. S is for spreadsheet. You're about to spend your money or someone else's, and usually this is the biggest expenditure that you will make in your lifetime. So spreadsheet your costs and your expenditure. Identify any areas where you can save. Get all your numbers down on a spreadsheet, every single penny, because the numbers don't lie. So if you overspend in any one area, say, for instance, you overspend on your renovation works, which really you should have it budgeted, but sometimes, it does go over, and it's always advisable to have a contingency, of a minimum of 5%, but normally 10% contingency of the work. So if it's 50 grand, have a 10% contingency of the 50 grand. If for any reason you go over on your renovation works, you might think, okay, well, I've gone over on that. It's come to the flooring. I'm going to pull back on the flooring, or it's come to, I don't know, the bathroom. I'm going to do a slightly different bathroom suite, which is going to look just as good, but I'm going to pull back some money there. So just make sure that you can study your spreadsheet and know where to pull back costs if you've gone over in any area. And last but not least, track time. Track builders and anyone else in your power team. Track the market, track everything to the end. So, if the market's fluctuating, you've got to track that. What's happening in the area. Has there been a change in something during the time you bought it to the time that you want to sell it? Has there been a change in government? Has Liz Truss come in and all the interest rates have shot up and house prices have plummeted? Track what's happening. Speak to the agents of the area. Is the demand still there for that type of property? Is it changing? Just track everything. Also track your works and make sure that it's on schedule, because time costs. Okay, costs more in interest, more in fees, especially if you're on a bridge, more in utilities and any holding costs. The true cost of anything is the time you exchange for it or the time you spend on it. Okay, guys, so that's it. That's the war chest. We've opened it, and we're going to start off with our cheapest finance. And for that, I am going to hand you over to Ade, who's going to take you on the finance journey, starting with mortgages. Thank you, Ade.
Thank you, Deanne. I love it. War chest. Okay. 1 minute I was walking, then I'm sprinting. I feel a bit like, I won't say Linford Christie because that shows my age. I'll say Usain Bolt. But good evening, everyone. Nice to have you with us. Okay, so Deanna's gone through sort of the things you need to think about and be ready to do. I'm now going to discuss the types of financing available to embark on the journey which has just been described. Now, there are different types of finance. And again, if you've got your notepad, that's great. If you haven't, then you can obviously listen to a recording at a later date, but try and take note of the stuff we're talking about now, because this is the stuff that's going to enable you to find the most cost-effective way and ultimately the most profitable method by which you go into a deal, not having to put too much money in and walk away with some good profit. Okay, so first and foremost, I want to look at what the definition of a mortgage is. I just want to get rid of this on my screen, put up there. Okay, so the true definition of a mortgage. A mortgage is a loan, that's a legal agreement, by which a bank or building society lends money to buy a property at interest. The funds given in exchange for taking title of the debtor's property for a designated period and until the loan is repaid. Simply put, it's an agreement between you and the lender that gives the lender the right to take your property if you don't repay the money you've borrowed plus the interest you agreed to pay. They are what I deem to be good credit loans, which are used to buy a home stroke asset or borrow against the value of a home stroke asset in order to grow or make further investments. Okay, great. That's the English dictionary definition. What we're really saying here in simple layman's terms is, if you lend me some money and I gladly borrow it from you at an agreed interest rate, providing I make those payments, it might be interest only, where you're just paying the interest on the amount you've borrowed, or it could be the capital, the amount you've borrowed, plus some interest on a monthly basis. If you keep that up, then we have nothing to do with your property. The moment you don't keep it up, we will take action and have the right to come after your property. So know what you're getting into when you are taking a mortgage. But that's basically, it's an agreement between you and a lender to make sure they're secured, but you get the money you want to be able to acquire the assets you want. Okay, moving on. If we look at the different types of mortgages, we're going to look first of all at mortgages for residential properties. As Dee alluded to you, that the cheapest form of mortgage is a residential mortgage. Now, a residential mortgage is one where you live in the property yourself. You've bought it to live in. To do that, because it's encouraged to people to own their own homes, the rates that are offered are much, not much lower, but they are lower than when you get into commercial or investment properties. So the key features of a residential mortgage, it's normally loan to value, which means whatever the loan is against the value. So you've got a value of £100, you borrow £90, that means you've taken a 90% loan to value mortgage. For residential mortgages, you can go as high as 95%. So you don't have to put much of a deposit down, which is a wonderful thing, especially when you're trying to buy your home or your first property purchase, which is normally a home. So a low deposit is really good. It's based on your earnings. If you are applying as a single person, generally speaking, a bank or a financial institution will give you 4 to 5 times your annual salary. Simple maths, I earn 50,000, I apply for a mortgage. The most I'll be given is either 4 times, which is 200,000, or maybe 5 times, which is then 250,000. But that is that is the mortgage that I have available to me, subject to other criteria that may allow me to buy my home. If you do it as a joint application, you can then find that, so if my wife and I applied, we could then get up to 6 times our salary. If our salaries are 50,000 each, that means 5 times we'd probably get a mortgage of 500,000. 6 times would be 600,000. But remember, there still needs to be of that. There still needs to be a deposit that will need to be paid. So you cannot generally buy a property for 600,000 with a 600,000 mortgage. There aren't any lenders that I know of at this present time that will allow you to do that. So the mortgage itself usually runs for 25 years. Because of the cost of properties in inner cities like London, some mortgage lenders are allowing you to go up to 30 years, especially if it's a young person and the parent will act as guarantor. So you can find deals that will go up to 30 years. It's generally a market for first-time buyers, and there are different incentives that will be given to the first-time buyers because the government believe that that's where it's the first-time buyer that keeps the property market propped up. Yes, that is very true. Also, the investment market is a good prop up as well. But as we're talking about residential mortgages, the first-time buyer gets the best deals across the board, both in terms of any taxes, in terms of any incentives. As a first-time buyer, they give you those. As a second-time buyer, less attractive because penalties do come across. You do come across penalties, but we'll get onto that when we talk about investment properties. The residential mortgage market is what's called regulated. So you have recourse. If a lender decides to loan you money and you take that loan and they misrepresent their facts, so you unfortunately therefore run into some kind of financial problems, you have a form of recourse that you can go to the regulator, the Financial Consumer Association, and they will be able to look at what went on. And in a lot of cases, you may be able to get your money back, or there may be something that's put in place that you don't end up losing your money. It's unusual, but they're there for a reason. And regulated gives you some sort of security and peace of mind, knowing that there is somewhere you can go if there are any problems. Okay, so that's the residential mortgages in terms of the purchase. Moving on, we move on to our types of mortgages for the property residential purchases. There are a wide range of mortgages, but 3 or 4 main ones. Some people prefer to know what they're going to pay for a period of time as an exact figure. So it can be paying an exact amount for 2 years, 5 years, 10 years, but they get comfort knowing that I've budgeted £800 a month every month for the next 5 years, and my calculations show that that's affordable to me. I've done it for 2 years, I've done it for 10 years, whatever it may be. But we call that a fixed rate mortgage. So your rate of interest is fixed, hence your repayment each month is fixed. Okay, that's whether it's an interest only mortgage or a capital repayment. And by that, I mean you pay part of the amount you borrowed as well as the interest that's owed to the lender as well. We do have a variable stroke tracker mortgage, which basically means it's a fluctuating interest rate. It follows the Bank of England base rate. So if the Bank of England announced tomorrow, we're having a cut in the Bank of England base rate from 5% to 4.5%, and we all pray that that's the case, your rate that you would pay on the Bank of England base rate is that plus a margin for the bank or the financial institution. So if the Bank of England base rate is 4.5%, a typical lender will want to make at least 1% as a margin, so they'd offer it to you at 5.5%. It may vary, as Dee and Ade alluded to the fact that, yes, the rate may be one thing, but when you then break it down and look at the real detail, you see they've got administration fees of another 3%. So spread that over the course of a year, and then you find, well, depending on how long you're taking it for, you actually then find it's more expensive. So look at the whole mortgage, as Dee said, not just the headline rate. And remember, with the variable or tracker, it goes up as well as it goes down. There's the discounted rate mortgages, which basically is an incentive for you to come and take the loan from a particular financial institution or bank, where in effect, they will give you a period at a discounted rate. So you hear things like join Virgin Media, join one of these organizations, and for the first 3 months, we'll give you 0 monthly fee. Thereafter, you pay this, or we'll half it for the first 6 months, and thereafter you pay at the full rate. That's exactly what discounted rate mortgages are. They will give you maybe the first year at a discounted rate, maybe 3%, 1.5% off their standard, but thereafter, for a period of time, they would then have you pay that whatever the standard variable rate, and that you will move automatically over from the discounted to the standard variable after a period of time. If it's 6 months, 6, 12 months, it's 12, but generally it's along those lines, 6 to 12 months. In terms of remortgaging your residential property, as Dee said, The cheapest form of finance or mortgage finance is a residential mortgage. So if you have a lot of equity in your property, and this may sound strange for some because, you know, we've all lived by the model of over many a year that you take a mortgage, 25 years, you pay it off over that period, and then you have a great fanfare when you've paid it off. But that means you've now got this great asset with no mortgage on it, but all the equity's in there. Now, you may need some of that to go on to do other things, especially if you're looking at building a property portfolio or you're getting into any form of investment. So sometimes we have to look at that, take out sort of fear and what we've lived with for years and say, why do I have £1 million property? I owe nothing to any lender. That means it's got no mortgage on it. It's unencumbered, but I want to get into property and I've got £30,000 in my bank. Well, that could change to £530,000 if you can get your head around the fact of, I now need to remortgage my residential home. Again, remember, it's based on your income, so that may have a limiting factor on that. But that's something, if you want to have a chat about that, we're more than happy to talk to you. And at the same time, if you speak to brokers, they'll happily explain that to you as well. And they'll give you an idea of what you can release at what cost. Okay, so remortgaging, very good way of raising money to do other things, but not to go on holiday and buy high valued assets, not assets, high value purchases that are going to diminish in value every day. That's not what I'm saying. If you are remortgaging, you put it back into something which is going to be an investment and grow with that money. Now, having spoken about residential mortgages, now let's look at those who have moved on from saying, I've got my residential, I've worked very well at that, I've managed it, I've now got lots of equity, I've done a remortgage, and I want to now get into property investment. So we're going to look at mortgages for investment properties now. The most typical one that we've been all using, any investors over many a year, when it comes to buy-to-let residential mortgages, and that's generally buying second, third, and fourth homes for people to live in. You rent it out to them, they pay your rent, and you're able to service your mortgage from that rental income. The key differences between residential mortgages and investment property buy-to-let mortgages is that you generally only get interest only. It's an investment. There's no point paying the capital. Take it as an interest-only mortgage. Just service the interest. If you rent your property accordingly and you collect your rents, which is very important, you will find that your rental income should service the interest on that mortgage. If you start trying to do capital repayment, it may flip on you and you may have to be topping up your monthly payment. And that's not what an investment is about. The income should service any debt that you've incurred to acquire that asset. You generally get a lower loan to value. Remember, loan to value, £100 property, you get £75 as a loan, meaning a 75% loan to value. When you start talking buy to lets, that's the kind of loan to value you're going to get. So you're going to have to find 25%. You might find one or two lenders that go up to 80%. You might find some that will only go as high as 70%. But you will find with the different types of loan to values come different interest rates and different criteria that you have to apply to determine which one works and is applicable to you. The affordability is not based now on your income. It's based on the rental income. So you can earn £20,000 a year, £25,000 a year, and go and buy a £500,000 house, providing you've got the deposit and providing the rental income will service the monthly payments of that mortgage you've taken to purchase that. So remember, it's not based on your income. And remember, with residential mortgages, because you tend to retire 65, 66, 67 officially, when you start trying to apply for a residential mortgage at 60, lenders are not that entertaining. If you did it on a buy to let, they don't really care, because now you're saying it's not based on my income, which may change in some time in the near future because I intend to retire. It's based on the rental income. And your age does not affect the tenancy that you have with somebody and them paying their rent. There are affordability stress tests, which means, what happens if your tenant didn't pay? What happened if the mortgage rate went up to a certain level? They stress it to make sure that if there's a little bit of movement in the interest rate, maybe the tenant doesn't pay the rent for 1 or 2 months, will you still have enough money to be able to service the loan? The impact of the stress test is generally that your loan to value comes down. So at a 75% headline rate, when it's stress test, you would normally get around 70%. Okay. So again, don't think buying a property, £100, I can get 75 from the lender, 25,000 from myself, plus the stamp duty, any legal fees. You may find that when the lender stress tests your application, they will not lend you 75,000. They will only lend you 70. So just something you need to do, as Dee rightly said, get your ducks in a row, get ready, see what's available to you before you rush out there and then buy your property. Portfolio landlord mortgages. These are very much like buy-to-lets, but they're for investors who own more than 1 or 2. In fact, 4 now is the threshold. People who own above 4 properties. Now, in the past, I remember when I was building my portfolio back in the 90s, I think it was in the 90s, 90s, early 2000, you were given a lot of respect for having a large portfolio, managing it, not getting any defaults, not missing any payments. You were given a level of credibility applied to you. So you were the preferred client over the newcomer into the investment market. Unfortunately, things have changed now. The portfolio landlords have to go to specific lenders because they are concerned about what might happen in a downturn. If we ever saw COVID again, what happened if the interest rates went up to a very high level? There's concerns about your ability to maintain that portfolio. So for individuals or companies who own more than 4 buy-to-let properties, there are specialist lenders who will work with you on those applications. There is a stricter lending criteria for obvious reasons. They will assess you across the portfolio. It's not just based on that one property you're buying, it's based on your portfolio, and that is taken into account. So again, talking to a good broker, coming to speak to us, we can go through this with you, and then you'll know what the likelihood is of what you can get. Okay, so that's the buy-to-let mortgages for portfolio landlords. Now, you can have alternative mortgages if you want to enter into the buy-to-let arena or sector. And those alternative mortgages come in different shapes and fashions. We've spoken about the standard ones, your residential for your home ownership. We've spoken about the buy-to-let mortgages and portfolio buy-to-let mortgages for your regular, I want to buy a home, rent it out to a family, collect rents and pay my mortgage. There are alternative mortgages like joint mortgages. Now, when I say joint, it's away from the joint of a residential mortgage. It's away from joint of myself and my wife buying a buy-to-let property in joint names. It's where you can find some mortgages where 2 people come together, they apply for the mortgage, but there is only one beneficial owner. Sounds a bit strange, but there are those mortgages out there. So I could buy with my friend. He really wants no involvement in it. The property really is mine, but he gives my mortgage application strength by being on there with me for whatever reason. But he has no interest in the property. All the deposit and other fees that are due to be paid come from myself. So jointly applied, but only one beneficial owner. You've got guarantor mortgages. I touched on that earlier, where parents may act as guarantors for their children or family members. And the same applies with investment mortgages as well. You can, with certain lenders, act as a guarantor for somebody who wants to get into some kind of investment buy-to-let property. You've got the self-employed and contractor mortgages. Remember when we spoke about income multiples, when we spoke about residential, we talk about your income only being a minimal level, 20, 25,000, generally 25 as a threshold when you want to buy a buy-to-let. So as a self-employed person or a contractor, You may find that your figures vary from year to year. Your submission to the HMRC varies from year to year. There's not a consistent upward movement like you may find in an employed person. So with the self-employed or contractor mortgages, there are specialist lenders. Again, can be financial institutions, can be high net worth individuals. And again, there are real specialist sector mortgages or lenders who operate in that field. And what I'm really alluding to is that there's normally some kind of mortgage for your circumstances. I think that's the point I really want to make. Okay. So they're the alternative mortgage forms. And yeah, again, once again, anything which does, if you don't fit into that square box, come and talk to us and let's put you in touch with people who offer different types of things. Commercial mortgages. Commercial mortgages, these are the ones where when we do a buy to let, it's an investment property, we're looking at the bricks and mortar value, we're looking at the rental income. When we talk about commercial mortgages, we're looking at that building as a business. So for instance, if you've got an office block, it might not be the bricks and mortar value, or the bricks and mortar value may only be 500,000. But when you look at the tenants that are in there, Safeways, Sainsbury's may have their offices in that block. You might find Texaco use it as an office block. It might be maybe a pharmacist downstairs, a chain pharmacist, and a good tenant with belonging to a large company upstairs. In other words, if your tenant is strong, your value of your business and that property in it is much higher than if you've got maybe a barber downstairs and upstairs is a company who just started running a law, maybe an accountancy firm or something like that. So the strength of your tenant is very crucial. And again, you're valuing it on not just the bricks and mortar. Your loan to value will be much lower, hence your deposit will be much higher. It's a commercial proposition, so your interest rates are going to be higher as well. The loans are generally much shorter, on average 10 to 15 years, but you can go down as low as 3 and as high as 25. But again, there are specialist lenders who will do your 25, but the average lender would do it around the 10-year mark. They assess everything. They make sure that the risk they're taking is commensurate with what they're lending, and they're happy that you have the good covenants with the tenants that are in there. The loan structure and the repayment terms differ from a residential. Again, you have to have the minimum turnover, the minimum traded period, and as a homeowner, or maybe act as a guarantor or a person with significant control. The whole commercial concept in terms of mortgages for those type of properties is very different to your buy to let. Well, it's got some similarities, but it's extremely different to your residential properties. So again, depending on what type of strategy you're using, if you're using mixed class, which is a bit of commercial at the bottom, retail, whatever, and upstairs maybe a bit of residential, then these are the kind of mortgages you would look at. Straight houses, apartments that you're going to let out to single families, you'd be talking about buy-to-let mortgages. Okay. All right, moving on. So some of our practical consideration and key tips. We've got to prepare for the mortgage application. Dee mentioned it earlier. Prepare. You must prepare. You've got to get yourself a good mortgage advisor, a broker to help you, and maybe search the whole of market. Or you could do a direct application with your bank or any other financial institution, but a good broker will show you what the whole of the market looks like. But that doesn't say don't see what your bank has to offer as well. You need to look at the interest rates around the economic climate at the time. If it looks as though mortgage rates are coming down, then why would you fix something for 5 years now? If you see that mortgage rates are going up, then maybe you do apply a fixed rate mortgage. If you're uncertain, you might go for a fixed rate, or you may say, I'll go for a discounted or variable. But again, look at the rates that apply at the time, at that particular economic time we're going through. Okay. Now, the one I really want to focus on here today a lot on is bridging loans. Now, bridging loans, I'm not going to even give you a definition, But a bridging loan, as Dee mentioned earlier, is a short-term loan. They have very much a place if you're getting into the property sector and building a property portfolio. The worst thing about finding a good deal is normally to be able to act on that deal and maximize the opportunity, you have to move quickly. That's why generally it's a good deal. Buy-to-let mortgages, commercial mortgages, on the whole, can take, on average, 6 to 8 weeks to process and the money hit your bank, and then you're able to complete on it. With bridging, it can be as short as 2 weeks. It really is quick. It's a way of acquiring the asset with a mortgage plus your own funds, with the lender making those funds available to you in the space of a couple of weeks. It's more expensive. We're going to look at the factors in there, but that's what a bridging loan does. So if you see a great deal, someone's selling a property for 350,000 because there's a problem, whatever that may be, divorce, debts to pay, banks calling in the loan, and you have to move quickly. If you move quickly, they'll sell it to you for 350, even though it's worth 450. You can't dilly-dally. You have to get that money very quickly. And bridging is one you really need to consider. So let's look at a bit of the detail of how bridging loans work. Okay, as I just said there, when a bridging loan is used at times like buying a new property, maybe you haven't sold your old one and you haven't released all your funds, so you're a bit short. You will have funds because your other property is going through on a sale, but right now you're a bit short and you've seen a good deal come up and you think, okay, I want to grab that. Bridging is the way forward. Auction purchases. When you exchange in the auction, or you put your hand up and the hammer goes down and it's allocated to you, you generally put down a 10% deposit on the day, and you have to find the balance within 28 days. You can't afford to go with the cheaper option of commercial lending or buy-to-let mortgages, because you may miss the deadline and then find out you lose your 10%. It could be used for when you need some money to renovate a property or refurbish a property. It's a project you've embarked on, but you're short of some funds. To try and get some funds quickly, a bridge could suffice. It's not to be taken for a long time. It's a short-term proposition. You take it, you use it for 3 to 6 months, and you give it back. As I said, avoiding property repossession, the lender's distressing you to pay back this loan, threatening to take you to court, threatening to repossess the property. You've got a strategy, but it's going to take 2, maybe 3 months to sort out, and the lender won't be patient. Bridge loan, get the money in, pay off the existing lender, fulfill your strategy in 2-3 months, get your money in and pay off the bridger. Okay, so it's useful at times, and horses for courses. The general loan amount is between 25,000 and it can go up to several million. There's no real upper limit. If the deal stacks and everything's in the way it is and the way it's meant to be, they won't limit it to 500,000, 1 million. It will go up to several million. The loan to value, generally speaking, is 65 to 75%, no more than that. So again, you're going to need to find deposits. Moving swiftly on. Interest rates. Interest rates are more expensive than your traditional financial mortgage or financial institution or banks mortgages. As we said, buy-to-lets, 4-5%, commercial, 6 to 8%. With bridging, it can go from 8 to about 12-15%. Just depends on the time you want it, how much you're putting in, what loan to value, obviously, you're looking at. But generally, the rates on a monthly basis can go from 0.4 to 1.5. The duration, as we said, it's expensive. It's not there to be used over a long period of time. Ideally, when I'm talking to clients, I like them to have it for no more than 6 months. But worst case, I would not advocate you taking it over 12 months. If it's going to be over 12 months, we need to look at an exit quicker than that. If there's no exit quicker than that, we may have to look and see if that's the deal for us, because we don't have the liquidity to be able to buy it. But as we said, there are alternative methods and there are alternative mortgages available. So if bridging doesn't work, we can look something else. But bridging for speed to try and get that deal, get in, short-term loan, and get back out. The repayment terms, in terms of how you service a bridging loan, you can pay monthly, but you have to show good affordability for that. To take a loan and then service it like you would a normal mortgage, the bridging financer will want to see you have the affordability to do that. Because if you had good affordability, sometimes the question will be asked is, why do you need the bridge loan? But as long as you can afford, you show affordability, they will allow you to service it like a normal loan. You can have rolled up interest, where the interest is added at the end. So you borrow 100,000, you've agreed to pay 10,000 in interest. So when you are giving back the money in 6 months' time, you have to pay 110. You will not pay the monthly interest as you go along. It's just rolled up to the end and added onto the balance of what you took as a loan in the first place. The retained interest is where they will deduct the interest from the loan amount. So someone may offer you a gross loan of £100,000, but their interest payments over the 6 months is going to be 10,000. So they will only give you a net loan of 90,000. They will deduct it from your loan application amount. So what quite a few people do is they ask for 120. By the time they've taken off fees, everything else, it nets out at 102, 103. So they, in effect, get the 100 that they're looking for. But remember, the more you borrow, the more you pay back. So bridging, it's about taking as little as possible and paying it back as quickly as you can. The cost of a bridging loan, as we said, we've got the interest rates are higher than the regular mortgages. They do charge you an arrangement fee, and that arrangement fee is typically 2%. Very few lenders do 1% now, but it's typically 1% for the lender as an arrangement fee. And the broker who got you into this lender, and it happens to be a much better proposition that you found elsewhere, will charge a fee of 1% as well. But again, those fees are added onto the loan or deducted at source from the loan, depending on if it's rolled up, depending on if it's retained interest. You will have to pay a valuation fee, which is paid up front. They will not pay that, allow you to take that out of the loan, because they haven't offered you the loan yet. So a valuation fee will need to be done, and you'll have to pay that up front. Again, valuation fees depend on the value of the property you're looking to purchase. Exit fees, some lenders do charge an exit fee of somewhere around 1%. I'm finding a lot of bridges at the moment don't charge an exit fee, and a lot of others are falling in line. But again, as Deanne rightly alluded you to the fact of some people hit you with a headline rate, and when you dig deeper, you find that, okay, 0.45, but I've got to pay a 2% exit fee. Someone else may be saying 0.75 as a loan rate, a monthly loan rate, but there's no exit fee. So you've got to weigh them up and see which suits your own proposition and what's working well for you from a financial proposition. Legal fees, as I said, again, these are something that won't be added to the loan. You will have to pay those to your solicitor, and sometimes they will have their own solicitor. 9 times out of 10, they'll have their own solicitor, and you have to pay their legal fees. So not only do you pay your own legal fees to your solicitor, you pay their legal fees as well, and that's an upfront payment. Okay, so what we've quickly done there, what we've done there, we've looked at residential mortgages, very cheap, what's the best way and who is it applicable to? We've looked at buy to lets, I want to buy a house, put some tenants in there, rent it, collect my rent and service the mortgage and let the asset grow. And we've then looked at the investment mortgages in terms of commercial mortgages, where you are now looking at commercial propositions and using that commercial strategy. But as an umbrella for all of those, bridging does apply. If you need to move quick, it doesn't matter what type of property you're buying, residential, buy-to-let, commercial, a bridge does apply. So if you have the need for that, know that's an option on the table. And on that note, I'm going to hand you back to Deanne, and she's going to give you some other creative ways and alternative methods by which you can finance. Been a pleasure. Over to you, Deanne.
Thank you, Ade. Thank you. Gosh, there's a wealth of information in there, guys. So I hope you had your notepads. We're not teaching some of you to suck eggs either. I'm sure some of you will know some of this already, but we're just trying to give you a little bit more detail, and we're not taking it for granted that everyone who's on here knows everything about it. We could have some young people that are here that are wanting to get onto the property ladder, don't know where to start. We're not taught this in school, so we're making it accessible to all. Okay, brilliant. So creative and alternative financing options, and that is JV, joint ventures, and private investors. Now, what does this all mean? Okay, so what is private finance and joint venture finance? Both private finance and joint venture finance are common methods used by property investors and developers in the UK to finance property purchases or development projects. They offer alternative routes to the more conventional methods such as mortgages and traditional loans. They can offer greater flexibility for property buyers, developers, and investors. So what are the key features of private finance? Number one, flexibility. Terms of the loans or investment can be tailored to the borrower's needs, okay? So it's not as rigid as those the ones that you find in the bank or through the broker. This is you with a personal individual now who's going to offer you some private finance. So they can be tailored to your needs. The interest rates, the repayment schedules, and a loan structure can all be negotiated directly with the lender. Okay, so in other words, if someone came to Ade or to me or, whatever, and said, look, I'd like to have a private investor, this is my deal on the table. Would you be interested in earning 10% on your money? If I took your money for 12 months, I want to invest it in a property, I'm going to renovate it, and in 12 months, I'm going to give you back your money with 10% interest. We might be inclined to say yes. That's a private investor, right? So speed of access. Private finance is often quicker to access than traditional bank loans, simply because there's not so much red tape to go through. Number three, less stringent criteria. So private lenders may be more flexible with criteria such as your credit history, your income, and the state of the property being purchased, okay? Some properties, believe it or not, might be deemed unmortgageable. If they haven't got a kitchen, or there's certain things wrong with it, sometimes they are deemed unmortgageable. A private investor might overlook that, looking at the bigger picture. And then four, risk and cost. Okay, so it may be deemed as higher risk by lenders. Interest rates may be higher than standard bank loans or mortgages. So what do I mean by that? It's deemed as higher risk for the lender because you might have a really low credit score, or as we say, that property may not be mortgageable because of a certain reason. For a number of reasons, it might be a high risk for that investor doing that loan. You may not have 3 years accounts or self-assessment tax returns, and your earnings are all erratic and can't really establish, what exactly are your earnings going to be next year. So a private investor is more likely to be taking a higher risk. Borrowers need a clear repayment plan as the cost of the default can be substantial, e.g. loss of property. So that private investor will want that property as security. They may be taking something else as security as well. You may have a main resi and now you're doing an investment property. They might want that investment property as security, and they may have security, use your home as security as well. So, you've just got to be careful just in case, it all goes belly up. That loss could be substantial. It's similar for bridging, though, to be honest, because that the same could be said for that. So types of private finance for property purchase. Private investor loans. An individual or group of private investors provides funding in exchange for a fixed return, typically higher than what banks offer. Investors could be family members, friends, or independent investors looking for a return on capital. Bridging loans available from private lenders. We've heard Ade speak about that, with terms generally more flexible than mainstream lenders, but at higher interest rates. So when I'm talking about bridging loans here under this heading, we're talking about an individual who, has some money, some funds that they use and they bridge out. So it might just be an individual person operating as a bridging facility or offering bridging facility as opposed to, a bridging company or whatever. There are individuals that do bridge. Then angel investors. So this is where wealthy individuals who provide capital for property investment are in exchange for ownership, equity, or convertible debt. Convertible debt meaning that they will invest some funds into your property journey or into your company that might be a property investment company. And then what it is they may not actually ask for a return on their money, but later on, when the value of the shares or the value of the company has gone up, they then exchange that for an equity share of the business. It's a great way for them to get in. It's good for you because it means that you don't have to worry about, oh my God, how am I going to repay them? But they come along and take their equity as your company increases in its value. They may invest for a financial return or for business partnerships, property development opportunities as well. Okay, next slide. Joint venture finance in property investment. Okay, brilliant. So joint venture is slightly different. A joint venture is property finance involves two or more parties pooling resources, usually capital, skills, or assets to fund a property project. The parties agree to share the profits and sometimes losses, don't forget them, from the venture according to a pre-agreed structure. JV finance is particularly popular for large-scale property developments or when an investor has limited capital but strong experience or assets to bring to the partnership. So for instance, I might go out there, find a property, and I haven't got all of the skills that I need, and I go to Ade and say, look, I'll manage a project. Do you want to invest and oversee it? Together, it's a joint venture. I'll be doing all the legwork and all the running around. I'll be managing people on site. He's going to be investing in and just kind of overseeing to make sure that I'm managing everything okay. And at the end, we sell the property and it's a 50-50 split. That's a JV. Oh, that's one example of a JV. That's not the only style or the only type. Okay, can I have the next slide, please? Thank you. So key features of joint venture finance. Number one, shared risk and reward. Financial risk and the potential profits are shared between the parties and outlined in an agreement. There must be an agreement, guys, at the beginning. You do have to have your heads of terms. You agree, put it down on paper, get a solicitor involved, get it signed off, and then you're good to go. Okay. Complementary expertise. So typically it brings together partners with different strengths. From one party might provide capital while the other brings property development expertise or property management skills. So just like what I explained a minute ago. Another key feature, flexible structures. JV agreements can be flexible in terms of ownership, profit sharing splits, equity stakes, and exit strategies. Partners can decide on different structures based on their roles and investments. And last but not least, number four, key feature number four, exit strategy. Clear exit strategies are key in JV arrangements. They outline how the project will conclude, such as selling the developed property, refinancing, or one partner buying out another. It's also important to determine, in your agreement or your arrangement, what happens or what would happen in the event of death. And you've always got to think of as many eventualities as you can. It's not that you're trying to be doom and gloom or morbid, but these things happen and you need to discuss and have in your arrangement, detail of what would happen in such an instance. Okay. All right. So protect yourself from the outset. Types of joint venture finance for property. So you've got equity joint venture, 50-50 split, money or expertise split, or, you know, money and expertise and management split, whatever the split, but you're deciding that it's just going to be a 50-50 share of the equity. Then you've got debt equity JV. So the debt equity means that somebody comes along, lends the money, and they want 10% or return on their money. So I find a property, I want to JV with Ade. Ade says, yes, I'm going to give you the money for that, and I want 10% interest return at the end, but I also want a share of the equity. I want, you know, 30% of the equity share as well, and the uplift in the value of the property. Okay, there's also one for me, one for you. So I buy one for me, and then I buy one for you, or I buy one for you first if you've invested in me, and then I go off and buy one for me afterwards. And that way, you know, what it is with that is that I will be doing all of the work. I'll be going out, I'm sourcing the property, I'm doing everything. It's hands off for you, but you are putting the money in. First property's for you, next one's for me. And if there's any interest or any money left in the property, if I'm refinancing and I can't get all the money out, whatever of your money is left in that deal, you know, I will be paying interest to you on that. So your money as the investor is still working for you and earning you interest. Then there's an earn and learn model. So someone comes along, they've got money, but no knowledge of property, no knowledge of how to build a portfolio, no knowledge of any of the strategies, anything, but they've got the money. I might say to you, okay, you give me the money, I will invest in the property, and you will earn and learn at the same time. So I'm going to give you a return on your money, and I'm going to teach you about what I'm doing every step of the way. So the next project, and you are now tooled up to go off and do it yourself, should you so wish. Great way, guys. Great way. Earn and learn. Then you've got the developer and landowner JV. That is what it says on the tin. You've got a developer and you've got someone who owns some land. They come together and they do a joint venture split, whether that be 50-50, 60-40, whatever they agree on. Same thing with investor and developer. An investor invests and the developer develops, and that's the JV model. Again, they agree the split between them. Thank you. So what's the comparison, or what are the comparisons between private finance and joint venture? So just to make it a little bit more clear, because sometimes people sort of think, okay, I want to raise private finance, but then they thought that JV was private finance, and it's all a little bit grey. So I've done a little comparison table, and it just highlights the key features or key differences between the two. So with private finance, the source is usually the private investor or the lender. So that's the source of the funds. It's usually from the private investor or the lender. Under a joint venture agreement, it might be slightly different. It could be a collaboration between the partners. It could be the investor, the developer, the landowner. It could be everyone puts in a bit of money, and then people have different roles. It could be one person puts in money and one person does something else. You know, it can be different. So the source of funds could be all or one or two, whatever, but usually with private finance, it's just the investor or the lender. The risk in private finance is usually taken by the borrower. And now you might think, but I thought the risk would be by the lender because they're the person lending the money. And so that's where the risk is, that they could lose it. Well, no, it's actually taken by the borrower. Now, the reason I say that is because, number one, the lender is going to take security. So if anything's going to happen, it's going to go belly up. They're going to take the property and you're going to lose that. Number two is if they've taken security on anything else that you have or own, you may well lose that also. So the risk is being taken by the borrower. You are the one that is being exposed, okay? The lender will go into it making sure they've dotted their I's and crossed their T's. They don't want to lose their money. In joint venture finance, the risk is shared between the partners. So usually everybody who's collaborating will take an equal spread of risk. Returns. In private finance, fixed returns or interest payments. So usually from the beginning, The investor will say, well, I want a 10% return on my money. That's it, non-negotiable. That's what it's going to be. With joint venture finance, the returns are profit sharing based on equity or debt equity arrangement. So, you know, the profits, you might sort of say, well, look, this is what we're going to want it to be. But, you know, you might get a gross development value that is more than, you know, than you thought it was going to be. So can be a little bit flexible. Usually you will stipulate from the outset, well, I want 50%, I want 40% or whatever. But, you know, at the end, if you've made a bigger profit, you might renegotiate that at the end. In private finance, repayment is typically structured with interest over time. And with joint venture finance, repayment is based on profit once the project is sold or refinanced. Involvement. In private finance, the lender may not be involved at all, may not be involved in the process. So you might go to Ade and sort of say, Ade, I want some of your money, please. Can you invest? And Ade will say, yes, I don't want nothing to do with it. Just bring me back my 10% in 12 months' time. Off you go. Make sure it doesn't go belly up under those instances, don't you? Won't you? Involvement.
I hope so. Don't take my money and lose it.
Well, you've got security anyway. Involvement in joint venture finance. Both parties contribute to the success of the project, okay? Or all parties. It could be more than one party in there. And last but not least, flexibility. So flexibility in private finance is often more flexible than bank finance, but still with interest and fees. And in joint venture finance, flexibility can be highly flexible in terms of structure, profit splits, and contributions. Okay, so it's slightly different. I hope that gives you an idea of the difference between them. So the advantages of private finance and joint venture finance in property. Private finance: 1, faster access to capital; 2, flexible terms; 3, less reliant on your credit history. Okay. Your investor will have the money, can turn it around quick. He's going to be, or she's going to be, a lot more flexible than a bank or building society or a lender. A lot less red tape and hoops to jump through, and they're less reliant on your credit history. Joint venture finance, shared risk. It's split amongst all those that are in the venture. 2, complementary skills. So one might have funds, one might have management skills, one might have development skills, you know, but the skills complement each other and everyone comes together to make that project happen. And 3, profit potential. Okay, there's great potential for profit when you collaborate. There's no I in team. Teamwork makes the dream work, guys. I love that saying. Vendor finance. So this is the final type of finance that I'm going to touch on here today. And that is, it's a little bit more creative. A lot of people don't really know about this, but as I say, I'm just going to touch on it. So vendor finance is, again, there's different types, and it's about thinking outside of the box. It's what you can arrange with the vendor or seller to make that deal happen. So typically it's where the seller agrees to finance part of the purchase. And a typical scenario where vendor finance is feasible might be that the vendor sells you the property for a cheaper price. There's equity retained in the property. You don't have to pay so much in stamp duty. You don't have to raise such a large amount of finance. But at the end of it, when you've been in there for a while, or you've done some renovation works or whatever, and you've created an uplift in value, you then can refinance and get more money out, pay them back because there's a higher value, and maybe give them a higher profit or share of the profit. So where they might have sold to you at, I don't know, 500k, you've gone in and bought it at 400k, you've paid less stamp duty, you've had to borrow less, you've done a bit of work, it's now worth 600k. Okay, so now they can get back what they initially wanted, get their 500k. You might be able to refinance some more money out, may have to leave some in, who knows, but you can get some more money out. There's a little bit more room because there's profit in there, and they might say, okay, I've got my 500 and I'll take 25 grand of your profit as well from the 600k. So 100k profit from the 500 to 600. and you've given them a share of that profit. There's many other ways. They could have savings in the bank and they say to you, all right, I'm going to loan you the money for the deposit, and you will pay me interest on that money, and therefore you buy the property and you pay them interest and you repay back the loan over an agreed term. There's many different ways to structure vendor finance, guys. So that's just a couple of examples, but it's all about being creative with the seller. And if the seller really wants to get the property off their hands, sometimes they really will sit down with you and say, well, look, I've gone into agreements where I've sort of said to, sellers, well, look, if you sell it to me for X amount, and I uplift the value by doing some renovations later on, I will give you a share of the profit when I'm flipping it to sell it. And they are happy to do that. Last but not least, you can structure those repayment terms with the vendor or the seller. Brilliant. Okay. So, factors to consider when choosing a financing method. Where are my factors, guys? So, number one, speed of transaction. Okay, speed. If you're going to auction, you're not going to want to get an ordinary mortgage. You're more than likely going to want private investor, cash, or a bridge. Okay, something that can move fast. So, consider what type of finance you're getting in relation to the type of project that you're about to do. Interest rates and overall costs, you've got to consider that, when you're looking at your product. Flexibility and control, okay? How flexible is this product? I don't know, a buy-to-let might not be as flexible as a commercial loan with certain things there, or a residential mortgage might not be as flexible as, a bridging loan. If you wanted to do something, you've got to look at what's the flexibility, what's the control, what's the exposure, am I able to exit this product within 6 months? Will I have penalties to pay? Can I sublet on this product? Can I, there's all sorts of things. Can I have can I have, all kinds of tenants, I should say, in this, or is it just restricted to an AST, an assured short hold tenancy? You've got to look at what the product allows you to do. And then risk and exposure, what risk are you exposing yourself? Bridging loans, really look at that, because bridging can be quite aggressive when it gets to the point where you need to repay. And if you haven't repaid, you're not in that position for whatever reason, you can't sell the property, prices have plummeted, whatever reason, what's going to be your risk? They usually tend to be a lot more aggressive than your ordinary residential mortgage. So just understand what you're being exposed to, and then also what the potential returns might be. Some are more expensive than others, so you may get less profit at the end. Always match the right finance method to your strategy, e.g. long-term investment versus quick flips, commercial, etc. So like I say, you may not go in with a long-term mortgage that's going to give you all sorts of penalties if you exit early, if you're looking just to do a quick flip and turn it around in 3 months, 6 months. Okay. All right. So recap. We have now gone from fund to funded, guys. We've done it. You've got your finance. You have, secured the property. And now this is where you are at. So back to the beginning. F, financials. Understand your financial position and assess it and understand it, know what it is that you can afford and everything, know where you stand financially. What can you afford to do? What's your position? What's your credit score? You understand the type of products that are available to you and the type of finance that is available to you. Yeah. N, navigate the market, go and find that property deal that you want. And then D, deliver on it, bring everything together, deliver, nail it. Do not do all of that running around, get the mortgage, find the property, and then think, oh, flipping heck, I'm not going to do it. I'm a bit scared. It's no point at that stage, guys. You may as well follow it through right to the end. E, Evaluate. So you've done all of that, you've delivered on the deal. Now what do? You evaluate what went right, what went wrong, what would you not do next time round, and what would you do next time round? Would you change your building team? Would you use that same building team? Would you use a different type of financing product? Would you not buy a property in that area again? You know, did it not sell as quickly? Did you not have the demand that you expected to have, or the target audience that you expected? Evaluate, you know, did it earn you enough profit? Is this a win-win? Is this something you would do all over again, or do you need to change your strategy? After you've evaluated, what do? You don't quit there. You decide your next project and you repeat by going back into your war chest and starting all over again. Rinse and repeat. You're building a portfolio, guys. Go back into the war chest. So you have gone from fund to funded. You've got your property, it's in the bag, and now you're about to go again. Okay, brilliant. So guys, I hope you are still there in the room with us, understanding everything that we have shared with you so far. I'm going to hand you over to the capable hands of Ade before we take a quick break for, comfort break, I should say. Drink of water, glass of wine, loo break, and then we'll come back and do that all-important deal analysis. You can't afford to miss that. Ladies and gentlemen, I'm going to hand you back over to Ade.
Wow. Okay. Need to go and find my war chest. Is that time? Thanks very much for that, Dee. Yeah, a lot of great stuff there. A lot of great stuff. I hope you've taken down notes, because if you haven't, you would have maybe missed one or two things. I think the reality is each topic, each section is particular to individuals. So try and take the points that are relevant to you, make notes on them. I'm sure if we compared 4 people's notepads, they'd all have different things on them. So you take what you want from it. It's not everything you have to take. Some of it you'll know, some of it you won't know. But you take what you want from it. If you don't know most of it, then please listen back to the webinar at some point when we post it online, and we will be sending you a copy of it. Listen back and refresh what was said and your learning experience. Okay. Now, in my past, maybe for my sins or for my good deeds, I was a teacher, and I always thought when I'm delivering a lesson or a lecture, if I don't have many questions at the end, then I've done a good job, because I've really been able to share with either the children or the adults I'm teaching what I'm trying to get across and making sure they absorb it. So if I didn't have any questions, I really thought I'd done a good job. So I think I may be able to say Dee and I have done a very good job, because in the chat box, I don't see any questions, which I'm not going to complain about, because it means we can go for, unless I get any questions immediately after this short break, we're going to move straight to deal analysis, where Deanne will be analyzing a deal. And we will have Q&A after that as well. So that's not a problem. But as I said, if we break now, literally 3 minutes, people, 3 minutes, we'll be back. And if there are any questions, we'll quickly go through those. If not, we're going to go move straight to deal analysis. Okay. See you soon. Great having you with us.
Which remortgaging is usually the cheapest type of finance.
It is an asset and it has value. And talking to the right financial stream now.
We purchased it at 410k. Its current value is 900, around 900k.
We make sure we do not offer shoddy accommodation. That's get into this game, do not be cheap and cheerful, poor quality. Let your standard reflect what you're offering and what you're about.
Okay. Okay, guys, we are back. I hope everybody's back with us. I don't want to delay for any reason at all. There's been a couple of questions in the chat box, and I'm just going to quickly go through and answer these so Deanne can get ready and then analyze the deal we have on the table. One question comes from somebody where the question is, finance for a property abroad. How to get finance for a property abroad, specifically Italy? The only thing, well, two things I can say. One is finance for different countries. You have to look at the country's way, the way in which that country works. What we're talking about here is generally property within England. I'm not even talking Scotland, but generally within England or Wales. So what I'm saying to you is, if you are able to raise finance from the UK in the ways Deanne and I have shared with you, and you can take that finance to Italy and utilize it, then that's great. If you're thinking about how to get a mortgage in Italy for a property that you used to purchase, then I have to admit that's beyond my remit, but we have got specialists in our team who, if you contact us, could advise you on that. In fact, I know that specialist was talking about somebody with regard to Spain and Italy. So get in touch after the webinar and we'll put you in front of them and you can have a chat. The second question that came up was, could you please give me tips for getting your first investor? Not more than what Dee has given you in this forum, because time is short. It's going to be difficult. The one thing I will leave you with is that investor, start with family, start with friends, start with people who you know maybe have retired and they've sold up or they've got a large pension pot. But the one tip I can give you immediately is go to family and friends, get out there networking, talk to people, and you'll be surprised how many people are available to become an investor because they've got cash in the bank. Okay, so that answers those two questions very quickly. I'm going to hand you over to
that. Sorry, I was just going to say, I'll add something to that, and that is that investors are actually closer than you think. You know, they're all around. I know someone who got investment from her dentist. It's very much about telling people what you do and, you know, giving them the opportunity to earn a return on their money. People have money sitting in the bank. People have equity locked up, not doing anything, you know, so it's really about being creative and letting them know the opportunities that are there for them to earn some interest on their money, which probably isn't earning as much in the bank at the moment. So, yes, really just be creative, talk to people, let people know what you're doing. And if the right deal, if you present people with the right deal, I should say, or an investor with the right deal, they will buy.
Okay, thank you very much for that, Deanne. Great addition to what I said there. So great. I'm very conscious of time.
Don't forget angel. Sorry, I was going to say, don't forget angel investors as well. Yeah. Thank you. Okay. Sorry, Ade. I was just saying, don't forget angel investors as well. Yeah.
Okay. I'm going to hand you over to Deanne now. She will now do the analysis of a deal that we've got on the table ready to look at. So again, without further ado, Deanne, over to you.
Thank you, Ad. Okay, guys, so are we ready to do a deal analysis? So I'm going to try and keep it brief as well. I say brief, it will be brief. I'm not going to go into every detail, but I just want to give you a general idea and overview of how we do a deal analysis. So can we have the slides? Brilliant. That was a really quick Q&A session. Excellent. Okay, so this is a project that one of my clients was going to undertake, and they presented it looking for investment. Okay, So we've just kind of concealed the property's address and who they are, just to, make sure we don't share that information, but everything else is here. So an investor opportunity for 300K, and they were offering 12% interest over 1 year with first charge security. It was a 4-bedroom detached bungalow, and they wanted to change it to a 5-bed, 4-bath and do a buy, refurbish, refinance on it. So they may not necessarily flip it. They might refurbish it and then refinance onto a proper mortgage, buy-to-let mortgage, and then take as much money out as they can. So what were their plans? And this is the thing, even if you're going to flip, guys, it's always about buying that property where you can buy it below market value as near as you can, like to have discussions with the vendor, whatever, negotiate on the price. You have got to know what's your bottom price that you will go to, or should I say your top price actually that you should go to. You've got to make sure, if you work backwards, you've got to make sure that you know what that property might be valued at the end. And then you've got to work out how much you're going to have to spend on it, including all of your stamp duty, which has just changed for investment properties today. I'm in the middle of a transaction, which because of today's announcement on stamp duty increase from 2% to 5%, it means I'm going to have to pay an extra £10,000. So I'm now going to have to build those figures in to my profit, because if it doesn't work anymore, then it's not a good deal. So you've got your end gross development value. You know exactly what you think this might be worth once you've done the works, and then you work backwards. Okay, so this is what this person wanted to do. They wanted to convert the garage into a bedroom and ensuite. So you can see here, there's a garage on the right hand side, and that person wanted to change that garage to a bedroom, and that blue square there, can we just put the cursor on that? That blue square is the bath, is an ensuite bathroom that they wanted to change it to. That's in the garage. Okay. Then they wanted to do a partition for the lounge. So at the moment, you can see that blue line where it says lounge. There isn't a partition there, but they want to create a partition, and they want to remove the wall in front that is colored in the yellow to make it a more open plan kitchen diner area. So they're just changing the general aesthetics of the property downstairs to create more room at the back area, and then a lounge partition towards the front. They want to do new windows and doors. They want to upgrade the fuse board and add sockets and lights. They want to turn the sitting room into the bedroom. So now there's going to be 2 bedrooms downstairs. There's going to be the garage into a bedroom with the ensuite, and there's also going to be the sitting room, which is going to be a bedroom, correct? Okay, they're going to tidy up the garden, add decking, and do a loft. Well, they say do a loft conversion, but they're going to add UPVC cladding to the loft conversion. The loft conversion is actually already there. As you can see, it's got 4 bedrooms up there, bedroom 1, bedroom 2, bedrooms 3, and then there is a 4th bedroom, which now has a blue square in it, or rectangle, which is now going to become an ensuite. So that bedroom is going to be taken away, leaving just 3 bedrooms upstairs. And then downstairs is going to have an additional 2 bedrooms using the garage and the sitting room. Okay, so it was originally a 4-bed. They're going to take away 1 bedroom upstairs, leaving 3, create an ensuite for bedroom 2. So it's going to be, a nice master suite up there. And downstairs, they're going to create another 2 bedrooms, bringing it up to 5. All right. So that's how they're looking to uplift the value. And that's a general principle of property, is buying property to uplift the value. Sometimes that might be over time. Sometimes that might be immediate. The over time is in the capital appreciation, where you're just sitting and waiting. And the immediate is you're going to do some kind of renovation, uplift the value, and either sell it, flip it, sell it, or refinance, take your money out and keep it, rent it out. Okay, so let's have a look at the figures that was presented. So these were the figures that was presented by the client. So maximum price 300,000. That was the asking price of the property, but she said that the best price, if she could get it for that, for her would be 280k. The stamp duty as of yesterday would have been 11,500 or 9,900 if she's got it for 280. Today that has changed. Okay, I haven't even worked out what it would be, but these figures are no longer valid as of today. The renovation would have cost 57,600, and she's done a breakdown of the renovation down at the bottom under the renovation costs. So you can see there exactly how that 57,600 would be made up. And then she's spending 3,000 on legals, 2,600 if she bought it at the lower price. I think that's slightly over what probably would be required. I think probably half of that, 1.5 grand to maximum, but you know, she's put in 3, so let's run with that. So that means that the total cash in would be 372,100. That's her purchase price, her stamp duty, her renovation, and all her legals. 372,100, 350,100 if she buys it at the lower price. Important to negotiate that lower price, guys, and get it on a good BMV, below market value. Gross development value, 450,000. So she's gone out and she has done her comparables. So you can ask the estate agents, what might this house be if I turn it from a 4 to a 5 and I renovate it with a nice finish? What might it be valued at? Thank you. 450,000 is what she has been told. So what does that mean? If she manages to achieve that, that means she will have made a gross profit of 77,900 just from doing this flip. If she manages to get it at the cheaper price of 280,000, she will have made 99,900. That's almost 100,000, guys, in profit. Then she is going to deduct the interest that she's going to pay her investor. Now that's 12%, so it's like 1% a month, 12%. That would be 36,000 or 33,600 if she goes for the lower amount. That leaves a profit of 41,900, or if bought at the lower price, 66,300. Hope you are all following me, guys. Is this all making sense? This is a real kind of, what's the word, basic way to have a look at what it might mean to buy a property, renovate it, and sell it on, flip it, or refinance it. These are looking at the figures in a macro, or with a macro lens, in a macro way, okay? All right, yes.
Question. So the interest of 36,000, it's based off paying 12% interest on what figure? Is that with all the money in?
300,000. So what's happened is a 300,000, how she had actually structured this was that the purchase price of 300,000 is all that she's taking from the investor. She was going to fund everything else, the 11,500 stamp duty, the renovation costs, and the legals. Ade?
Yeah, no, just wanted to make sure people were. I kind of know the deal, so.
All right. Okay.
So I got that, but the bit I didn't hear was I thought, let's make sure people know where their 36,000 is coming from.
Cool. All right. So then feel free to just say it. Just say it. Yep. It's all good. Okay. So 300,000. That's all that's being invested by the investor. She's funding everything else. 36,000 is what's being paid in interest. 33,600 if she buys it at the lower price, 280. All right. So if we go over now to her comparables, and that's a key part of buying a property, really, is knowing how to look at the comparables. And I don't want to go too deeply into this, guys, because it's quite an in-depth part of the due diligence process, looking at the comparables, but it's an important part of the process. And that is because you want to make sure, it's important that you know that you are going to get that value at the end of doing those works, you know, that gross development value. We call it GDV. GDV, the gross development value. You want to make sure that you're going to achieve that. So you can speak to your estate agents. Estate agents typically tend to kind of overvalue property prices just a little, because they want your business. And so sometimes what might happen is the estate agent will tell you, well, yes, this is what it's valued at and you'll get this price. And then your mortgage lender or whoever it is, bridging lender, will come out and do a valuation and they'll value it at less. And you think, but hold on, why have they valued it less? Well, actually, perhaps they haven't actually valued it less. And sometimes they do kind of, you know, are a little bit conservative as well, because they are the ones exposing themselves when lending. But you'll usually find that the lenders will have their valuation done and it will be slightly lower than what the estate agents have valued it at. Now, the estate agents, like I say, want your business. So it's not unusual for an estate agent to say, well, it's worth 300,000, and then in 3 months' time, there's been no interest, and they come along and say, well, it's not really getting any interest. Let's drop it to 280. Well, really, to be honest, it probably should have been on at 280 in the first place, but now they've got your business. So, okay, so just always bear that in mind. So it's good for you to do your own comparables, and just again, having a look at this, she's got 4 different properties here. She's got one on the left, and that property was a detached bungalow, which sold in October 23 for 415, and that was a 4-bed, 2-bath. Don't forget, she's bought a 4-bed, she's changing it to a 5. There's another bungalow that she's looked at. That's a 3-bed, 1-bath. She's looked at another one. It's actually a detached house. That's a 4-bed, 2-bath. And then she's looked at a 4th one, which is a detached house, 4-bed, 1-bath. Now, to do your comparables, what you really need to do ideally is go out to a maximum of a 1/4 mile radius, find a like for like property. So if you're going to be selling on a 4-bed or selling on a 5-bed, as she's going to turn it to, try and find a 5-bed, 2-bath. If it's going to be a 5-bed, 4-bath, try and find a 5-bed, 4-bath within a 1/4 mile radius, and preferably what has been sold within the last 6 months. Okay, so these are the parameters within which you work. 1/4 mile radius, like for like, sold within the last 6 months. If there are no properties that you can see that fit that criteria, you have to work your way out a bit. So maybe you might say, okay, a property that sold like for like, but within a mile radius, or 8 months ago. So you take it out little by little, maybe use within a mile radius first. And then if you can't find anything within a mile radius, go out to 1 year ago, as opposed to 6 months ago. So that's how you find your comparables, and definitely go by the sold prices and not by the asking price. The asking price does not really mean anything. It's really about what has sold, because that is what is setting the precedence in the area. Okay, that's what is important. Also, when I say like for like, look at the finished quality of the project or of the house, the property that you're looking at, in terms of what you're using to compare. So it's no point looking at a 5-bed, 4-bath that hasn't been renovated since the 1960s. You know, find a 5-bed, 4-bath that is renovated to the standard that you know you will be bringing yours to, and see what that's sold for. That will give you a good indication. The last thing that I would say you need to make sure that you look at as well is the size of the property. So you can see here, this property shows that it was 112 square meters. The next property beside it was 99 square meters. The one at the bottom, 111. And the property that she's planning to do up is 112. So that's very similar in size, as is the property on the left. And then the last one is 150 square meters, which is a house. So that's, much bigger. But what you do is you can actually break down whatever the property has been sold for, break it down by the size. So if it's 500,000 and it's 99 square meters, you will basically do that calculation. So let's use one of these here. 112 square meters. This property was 415,000. That's the one on the left. It's 415,000 and it's 112 square meters. When you break it down, divide the price by the square meter, it works out to be 3,705. Now, if that's a like for like, and yours is 112 square meters, you can almost guarantee that you will get 3,705 per square meter for your property too. That will give you your end price. If your property was slightly bigger or slightly smaller, say 99 square meters, you might take that 3,705 and then divide it by 99 square meters, which would give you a slightly lower value. We have to kind of look at that in a deeper way, and we probably haven't got time to go into that now. That's a whole separate webinar on its own, deal analysis, but it's just to give you an idea of how you might look at the comparables for yourself, as opposed to just using what an estate agent would tell you. But should you want to go any deeper into that or get any more learning on that, please do feel free to contact us at NPC. So look, I'm just going to take a quick look at these figures in terms of looking at it in a deeper way. These are some of the costs that you might need to consider if you were going to do a more detailed spreadsheet analysis of your property deal and whether it works or not. So if you bought it for 300,000 and you spent 57, we're looking at column 1, investor 1, 57,600. All in all, that's 357,600. Now, when you've got added your costs in terms of your stamp duty and your legals, 13,000 stamp duty and legals, your holding costs, that wasn't in the first sheet. Your holding costs, your council tax, your electricity bills or gas bills whilst you're renovating the property, your insurances, your renovation insurance or whatever holding costs you have, you add that into the equation. Your contingency for your building works, your 10% contingency, 5,760. So total finance required, there it says investor, but total finance required 380,000 and some change. If the investor was doing the whole thing at 12%, that would be the interest that would be payable to them, 45,659. So all in all, you would need to pay back 426,155. So that includes all of the costs and the investor interest. If your GDV, your sale price is 450, that now means a total investment or profit of 23,804. So it's your GDV, and that's minus your total investment. Okay, your gross development value minus your total investment leaves you with 23,844. When you sell it, you always have to pay your sales cost, 1% seller's fees to the agent, 4,500 because it was 450,000, and then any sales and legals, so additional legals, I should say, £1,000 for your solicitor and anything else that you have to pay in order to sell. That's now brought your funds down or your profit down to 18,344. So I'm just giving you a little bit more detail just so that you know that there are more figures to throw into the pot. But like I say, we're really just touching on this. You've got to make sure that once you add all your figures up, that at the end, it's going to be worth doing this project, because if it's not worth spending 6 months to 12 months doing it if you're going to come out with little and nothing. Okay. So I hope that makes sense. And I'm sure we will be doing a separate webinar on deal analysis in the future.
Okay.
Right. So that's it. Shall we go to our next slide, please? Thank you. Over to Q&A. Are there any questions on the deal analysis? Okay, where are we? Hi, I love to learn about how to deal with commercial properties, how to negotiate while holding, to find the trader and while raising the finance. My intention is to purchase lease option while renting it out to a trader company on long-term lease. Okay, Ade, do you want to say anything on that?
I'm just trying to find that question actually, because I'm looking through what key factors should we prioritize? Is that the question?
No, it's right. It's third from the bottom. So it's hi. I'd love to learn about how to deal with commercial properties. Okay. How to negotiate while holding, to find the trader and while raising the finance. Yeah. Okay. So, I mean, that's quite a detailed question. Your intention is to purchase lease option while renting it out to a trader company on a long-term lease. Okay. All right. That's quite a big question. There's a lot in there, and it's very much, commercial is so different to residential. It really, really is. Ideally, I mean, obviously, if you're looking to find a brand to put into a property, ideally, you kind of want to tie the two up simultaneously, if you can. You either have the brand already, and then you're going out and looking for the property, or because if you have that property, it might take a little while to find that brand. There is a website that you can go to find brands that are looking for properties, but I mean, that's a very, very detailed question. So I really would say try and come to us at MPC for us to sit down and kind of have a chat with you on that. Ad, I don't know if there's anything else that you'd want to add to that.
In fact, I thought I'd responded in the chat box saying, yeah, that's a question you really need to contact us. That's not a 2-3 minute answer of any diligent answer that we'd give. So yeah, contact us at the office. More than happy to go through that with you.
Okay. Brilliant.
I see one here. Would you recommend starting my property portfolio with a limited company or just start buying in my own name at first? Can the properties then be changed to the limited company at a later date? I can definitely answer that one. You must buy in a limited company because the tax regime now says if you buy in your own name, you're not allowed to deduct the interest payments as a cost. If you buy in a limited company, as it stands at the moment, and we are definitely going through a period of change, you are able to do that. So start off in the right way. Set up a limited company, buy in a limited company, and grow your portfolio in that limited company. Unless you're doing flips, then you may have several limited companies. We call them specialist property vehicles, and you do each project. If you're doing a flip in that particular company, you close it up at the end, you pay your tax, and you move on. And the next project you're doing another company. But if you're looking to build a portfolio, definitely in your own in a company structure.
Brilliant. Thank you, Ade. Someone has asked, how do you think AI and tech will transform the property buying and property financing market? Good question. It's already transforming it. Before, you used to just kind of have the agent's website, and you used to kind of just have your Rightmove and your Zoopla. Now there are so many different platforms that you can go on and look for property on. And the way that the platforms are set up, I mean, you can literally just kind of filter everything that you want, whether it be area, what's sold around the area, how long that property's been on the market for, what it was first listed as, what it's been dropped to, how many times it's been dropped. If you're looking for HMOs, you can look for them all over the country. You might decide that you want to filter a certain part of the country, those that have just been relisted, so those that have been on for a long time, that might indicate that you've got a motivated seller. There's all different platforms at the moment, from Property Market Intel, Property Engine, Property Filter. There are loads out there. So just go and do a search and find them, but you'll find that all of these property platforms are now really AI led, and that will make a significant change for estate agents, because people are sourcing their own properties now and finding them themselves.
It's funny, Dee. Someone said to me the other day, they're a property developer and investor, and they said the worst thing that ever happened to them was the onset of the internet. He said to me, before, someone would wanting to sell something, I could go and sit down, have a cup of tea with them, we negotiate a deal, and they tend to walk away with both parties being happy. He said, now you try and have that conversation, they just pull out, they open their laptop and just say, no, this is sold for that, that's sold for this, so I think the moral of his story and mine to you is that getting below market value properties now is not easy, because the general public are much wiser. They have the information at their fingertips. And talking about AI and what's coming with that and all the technology, as you can imagine, you can probably ask an AI filter about your property, what it should sell for, is this so, and they'll tell you everything about your property and what you should sell for. So going and negotiating deals with people is becoming harder and harder.
Brilliant. Okay. Someone has also asked, with the stamp duty change, does that come into effect straight away? Yep. Well, I was listening to the budget today, and it's as from tomorrow.
Wow. I didn't even know that. I was hoping it would be in the new financial year, i.e. 1st of April, or worst case 1st of Jan. But okay, I haven't heard the budget, but now you've said that. Okay.
It's as from tomorrow, hence why I said I was doing a property deal, and as of yesterday, or as of today, I have to pay 10 grand more. Well, as of tomorrow, because I didn't do it today. Yeah. So yeah,
okay.
it's 10 grand.
All right. So thank you very much for your questions. I'm going to let Dee see us out this evening, but just would like to say, because I'm not going to come back on, I'd like to say thank you very, very much for your attendance. Thank you very much for the good questions. As they say, it's not about quantity, it's about quality. Thank you for some very good questions, which we hope we've shared and given you some enlightenment as to solutions to or answers to those questions. But I think what I would say is that some of those definitely need to be spoken about in more detail. Dee and I are here at 10PC. If you have any questions, if you have any queries, if you have any concerns, if you have any issues, I would say that we are here to assist. So on that note, I'm going to hand you over to Dee, and she'll see us out.
Thank you, Ade. So just to say thank you again for coming. I know we haven't answered all of your questions in the chat box, and I had a feeling that was going to be the case. But, please do feel free to reach out to us, make contact with us. As I said, we also do a Q&A the first Wednesday of every month at 7 p.m.
Free.
And it's free. It's free at 7 p.m. So please feel free to repost your question there. Our next one is coming up next week, Wednesday. Okay, so sorry if we didn't get to you, but thank you for coming. I cannot leave without leaving you with a quote. And that quote today is, dreams do not work unless you do. Okay, so anything that you want, get the education and get going. All right. We look forward to touching base with you. We look forward to meeting you. We look forward to helping you. We're set up for the community. So until we see you again on our next webinar or Q&A, thank you for joining us. Do not count the days. Make the days count. Okay. Take care all.
Thank you.
Bye-bye.
Good night.
Good night.